Welcome back to the Build Wealth, Retire Rich series. Today we are going right back to basics with a crucial question. What is a stock? If you have ever heard of people talking about buying, selling or trading stocks and you're still not 100% sure what that means, then stick around. By the end of this video, you'll have a clear understanding of what a stock is and why it's important for growing your wealth. So in the simplest terms, a stock represents a share of ownership in a company. When you buy a share of stock, you're essentially becoming a part owner of that company. Depending on how many shares you own, that ownership might be tiny, but it still counts. Companies issue stocks for various reasons, often to raise money to fund projects, pay off debt, or expand their business. In return, investors like you and me buy these shares in a hope that the company will perform well, causing the stock price to go up and potentially pay dividends. So why it matters? So why should you care? Well, historically, the stock market has provided one of the highest return on investments over the long term compared to many other asset classes. If you're trying to build wealth and eventually retire comfortably, investing in stocks, among other assets, can help you reach those goals faster, thanks to growth and compound interest over time. So how do you make money from stocks? There are primarily two ways you can make money from stocks. First, capital gains. This is when you buy a stock at a certain price and sell it later at a higher price. The difference is your profit. And then we also get dividends. Not all companies pay dividends, but the companies that pay dividends. So some companies share a portion of their profits with investors in a form of dividends, which can provide a steady income stream. Not all stock pay dividends, but many well-established companies do, like some big tech companies, consumer goods companies, and utility companies. So what are risk factors and volatility? Of course, it's not all sunshine and rainbows. Stocks can be volatile, which means the price can go up or down quickly based on company's performance, market sentiments, or even global events. It's important to understand your risk tolerance and invest wisely. Diversifying your investments, meaning not putting all your money in one stock, is a key strategy to manage this risk. Let's look at an example here. Let's say you buy 10 shares of ABC Tech at $10 per share. So your total investment is $100. After a year, the stock price goes up to $15. If you sell at that point, your investment is now worth $150. So you would have a profit of $50. That's a 50% return on your initial $100 investment. But remember, it could also go the other way and drop to $5 per share, which would then value your shares at just $50. And there you have it, the basics of what a stock is and why it matters for building wealth. If you want to keep learning, be sure to check out the next video in the series where we'll be talking about what is a bond and how it differs from a stock. Don't forget to like, subscribe and hit the notification bell so you never miss an update on how to build wealth and retire rich. Thanks for watching and see you in the next video.